Hey, good afternoon, everybody. Tom Stewart here. I am with Liz Trotter. This is Smart Business Moves. Hello, Liz.
Hey y'all, how you doing, Tom?
I'm awesome. How are you today?
Wow, I'm thinking you really look festive today, Tom.
You
I,
know, I had to go crawling around in the attic for this.
yeah, and it's a real hat. I thought for sure you were gonna come on today with some sort of a virtual hat, right? But that's actually real.
Real deal.
That's nice. You see mine? You see that my hat actually matches my earrings?
Oh my goodness.
How cute is that? Yeah.
So, and I mean, you've been doing this all week, and everyone's been different, and
Okay.
that is that is too much.
Yes, you will see me different every day until Christmas Day. On Christmas, I'll take a break. Like,
Yeah.
okay. Christmas morning, and some of these are really comfortable. So you don't wear the headband type, I'm sure, but a lot of the women will tell you that the headbands can tend to be, hey, Maria, hey, Judith. A lot of the women will tell you that the headbands can be just almost like torture devices, but I have some of the best ones ever made. They're just so gentle on
You
your
know,
little scalp there.
yeah, I imagine if they had a little too much spring to them over the course of the day, that could get old.
The one I wore last night or yesterday on the call, the reason why I put it on specifically for the call is I can only wear it for like an hour at a time. It starts to give me a headache. I'm not going to get a headache for Santa. Sorry. All right. So we got two people on here already today. Hey, you guys, if you're on here today, let us know. Just give me I am over here in the comments because we are trying to figure out who is interested in this topic of profit. We are really going to be focusing in on profit over the course of the next few weeks, like Tom was talking about on Thursdays. And so we're trying to find out who is interested in this topic of profit. Judith, Maria, no, not so much. I am. Good. Linda, excellent. I'm glad. Thank you. We really want to see if this topic makes good sense. Moving forward, we plan on doing a lot more focused trainings, education, just offerings in this group. And so we want to find out, hey, oh, I love, is your name Celicia?
Yep.
That's pretty. That's very pretty. Julie, excellent. Great.
Celicia's a new Made Central user.
I love that name. I bet people say Cecilia all the time now. I bet she just gets it. But okay, good. I'm glad there's a few people on here that are into the information about profit. Well, without profit, do you really have a business or is it a liability?
I love it.
Yes, agreed.
That's pretty much it. Yeah.
Good to see y'all.
And if you're here and if you aren't sure if you really want to hear about profit or not, hopefully if we do our job today, by the time we're done, you'll definitely, regardless of where you are on the spectrum, you'll be more excited about crunching numbers for profit, because without it, we really are kind of wasting our time, aren't we?
Yeah. Unless you just need a new hobby. Tom, no? No,
I mean, you can take up golf or fishing or something. I mean, because
it's way better than golf or fishing. I'm just saying.
Well, Maria's talking about the liability, though. I mean,
yeah, that's true.
Some bad things can happen in your business. If you're not making money, then you really are just kind of waiting for something bad to happen with no reason to.
All right, I'll give you that.
So before we jump into to profit, we want to talk about what we're doing next week.
Yeah. All right. So for those of you that were on this week when we had Sharon on, you see that Liz interrupted her so many times that she could not get her entire presentation out. Sorry, Sharon. I had to apologize to her. So, of course, she was gracious and said, no, Liz, didn't bother me at all. I was fine. I'm happy to come back. So, yay, she's going to come back. She's got some more stuff to share with us, thankfully. Great, Charles. I'm glad you are too. That's excellent. Let's say I have my Brainiac office person daughter on today for this. She does our numbers. Yay, good. So that's another IM there. Great. Good to see everybody. All right. And then Tuesday, I'm going to be talking about, we have these, the order is a little bit wonky on these. We have Matt talking about how to do annual planning during COVID-19. And then we also have me talking about getting strategy right for the new year. And ideally, we would like to do these in the reverse order, but Matt has something cool that he's doing on Tuesday. So he had to go on Wednesday. So you'll have to watch both of these just to get them right. And then Tom,
a bike ride or a marathon. What's he doing?
I was hoping you weren't going to ask me, Tom, because I can't remember. I just remember he had something really cool going on. I was like, oh yeah, well, we don't want to mess with that. That's cool. So I could look, but I don't remember what it was.
Oh, that's okay. Well, he'll tell us next Wednesday what a great time he had Tuesday.
He will. That's exactly right. I'll know to ask him. All right, and then Thursday, you're talking about KPI.
We'll just be picking up where we leave off today.
All right, cool. I love it. Getting everybody on board with. Basically, we're just trying to get everybody on board with this idea of tracking your numbers and how it's a good thing, and get you like kind of pumped up and energized for tracking your numbers, because you can see the value in it and you can see how it could really work for you and help you grow your business. So I'm glad we're getting some people that are on board with this idea.
And we're approaching this from a different angle. I mean, we've been talking about numbers, and we've been doing classes for years on the KPIs and the numbers and financial statements and yada, yada, yada. And a lot of times we jam a whole lot of stuff in a short amount of time, and it's like getting hit with a fire hose. And gee, since we do this like every day, it seems, Liz, I mean, we've got all the time in the world to do this. So we're going to slow down, and we're going to really like have a discussion, and not only just talk about the math part of it, but the business case as to why it really matters to begin with, and what these numbers mean to us, and what we should be doing based on what the numbers are telling us. Yeah. It takes longer. But
and also one more piece. So some of you are probably going to be feeling like, oh my gosh, are you kidding me? This is so simplistic. It's too simplistic. But our experience has taught us that not a lot of people get training around the financial language and the lexicon. And so just the language is sometimes a struggle to grasp. And it's kind of like speaking a second language where you have to translate it in your head, try to figure it out. So we want to get everybody on board with, these numbers, all these names, these words, these numbers, all sounding really easy and natural and feeling very, very comfortable. So we kind of hit the same message kind of over and over again for that.
And we want to go beyond being able to answer the question to really understanding the reason why behind it and what to do with it. Leslie asked a really awesome question last week. I believe it was about, payroll to revenue. Why does it really matter? Why can't you just throw all your expenses together? Yeah. And we're going to answer that today in a more comprehensive way. We're to the point where we can kind of drill in that a little bit. So, we can teach you how to calculate payroll to revenue pretty quickly, but if we really don't explain what to do with it and why it's important, it really doesn't matter much.
Right. You can do it, but if you're not using that number for anything, why even look at it? Why even pay attention to it? So great.
What's Dan telling us here?
Yeah. He's such a jokester. Hey, Dan, good to see you.
He was on our call earlier today for Maid Central.
I wish was it a good call? I had to go to the orthodontist. I missed it.
Pretty good. It was good. We had a debate of is it called Favicon or Favicon?
All right, what'd you come up with? Was there any?
It was kind of split actually, but we put a new one on Maid Central, and that was kind of a big thing because the development team, they're like working on some meaty stuff, and we brought that up, and it was like, what? Really? I mean, is that really what it's like? Just, takes 5 minutes.
So before I forget about it, just real quick, Julie or Dan, either one of you guys, can you remind me to hit Ben up? He said he wanted sorry, this is totally off topic, y'all, but I will forget again. It's been days. Can either one of you guys remind me in group to hit up Ben because he said he wanted a Main Central demo. Sorry. Yeah. I haven't done it. It's been days. It's been since Monday. I keep forgetting. So if one of you guys could remind me, that'd be great. Thanks. All right. Go, Tom. Sorry.
Thank you, Liz. Okay, real quick. I mean, this is what we talked about yesterday. Is profit good, profit bad? In some instances, in some circles, profit has a negative connotation. Profit is a tool, and it's what you do with it. And if you remember, It's a Wonderful Life. Old Man Potter, George Bailey. Old Man Potter is kind of the negative connotation of profit, and George Bailey is the positive. And we want to be positive because when you have profit, you have an opportunity to build an awesome business, create great jobs, provide great service. If you don't have profit, it's going to be a lousy place to work. You're not going to really be able to provide good service. You're going to be miserable. It's not going to be an awesome business. So there really isn't a whole lot of middle ground there. If something good's going to happen, you're going to have profit. If you don't have profit, not much good is going to happen. We talked about the big KPIs that the Mastermind Accountability Group uses, and I guess the big takeaway here is profit is at the top of that list. That's not an accident, is it, Liz?
No, definitely we want to be focusing on net profit. When we first started putting these groups together and deciding how they were going to work, one of the things we noticed was none of the business coaches really focused on net profit. They did a lot of other stuff, including us, like in foundations, we didn't really put a ton of time into profit. We put a ton of time into systems and, all of the foundational things that need to happen in your business and all of the business fundamentals, etc. But where was profit in that whole conversation? Usually it was this big. And I was seeing people all the time who had very little net profit and sometimes no net profit. Sometimes we were running into people that were celebrating because they didn't pay any taxes at the end of the year. It was like, woohoo, yes. Or they were getting a check back. It's like, you need to be making more money than that. So, hey, look at that, Tom. Leslie likes your hat too.
Awesome. Thank you, Leslie.
So we really decided net profit was going to be a big deal. Also, we've got a few people in the MMA group on this call right here. So I just want to point out to you guys that next year there's going to be even more focus on your KPIs. So just FYI. All right.
And there are a bunch of other numbers that we need to track in our business that are kind of like lead metrics, leading indicators. And if you control all the numbers in the gray, then you're going to get the numbers that you're looking for on the green, or at least you're going to be a lot closer to it. And, you got to do a lot of things to get that net profit. But if you aren't managing and measuring that directly, you're missing an opportunity. So that's really where we're going to drill on that a little bit today. I think this is about where we got last week, isn't it?
I think you're right. I think this might be when Leslie was asking the question. We're like, ooh, we're going to have to answer next week. I'm pretty sure.
And, the whole model is, and I'm going to put my cursor in the right place so you can see it, that in this example, you have a company that's doing $100,000 in revenue with a cost of goods sold of 55%. So 55% of 100,000 is 55.
Hold on. I got a quiz. First person to tell me, what is revenue? Revenue, please tell me, somebody. All right, go, Tom. And then I'm going to get Cogs. So if you want to think. All right, go ahead, Tom.
I know
you do.
Okay. So the Cogs, I need to explain this part, is basically what you're paying your technicians to clean for you. And every time you clean an extra house, you have to pay a little bit more in Cogs. That's where the 55% comes from. For every dollar you bring in, you're going to be spending another 55 cents in payroll to the people that are cleaning the homes for you.
We might need to just go back just a little bit, Tom. Nobody is telling us what revenue is. So maybe we need to hit up what is, oh, here we go. Sales. All right.
You're cleaning. Okay. I'm gonna have to. I made some slides for us today to kind of graphically show this a little bit better, but I didn't do this. So
I got Felicia's with total income. Okay.
It's the money that people pay you for cleaning their homes. It's the money that they give you for cleaning their homes. Revenue, sales.
It can be sales or it could be total income too, because could your revenue be the money that you make when you hire an independent contractor to do carpets, but then they give you some money? So you're not doing any cleaning, but you're getting money?
If you're subbing it out and they're giving you an override, say 10% of all the work that you sub them, yeah, that would be revenue too. That would be a form of revenue.
Money that's coming in.
So I know that we're going to be talking about strategy next week, and we talked about SWOT analysis a little bit over the last couple of days here. So yeah, I mean, you can develop strategies to generate revenue in ways other than cleaning people's homes. You can sell them cleaning products. You can provide other services, to the limit of your imagination. But it's the money that people are paying you for something, the money that's coming into you.
Yes, the money that's coming in, yes, but not, it's not cash. So sometimes people think of revenue in terms of cash. It's not that. So,
yeah. Somewhere down the road, we'll be talking about balance sheet stuff, accounts receivable, and, if you've done this long enough.
Not yet.
I'm sorry?
I said, don't panic, not yet.
Not yet, somewhere down the road. But if you've done this long enough, I'm sure you've had that meeting with your accountant, your CPA, who says, congratulations, you made a whole lot of money this year. And you go, it certainly doesn't feel like it because I don't have any money in the bank. Well, that's too bad because you have to pay taxes on all that money you made this year. And you're going, what money? That's the difference between, revenue and cash.
We got a question here, Tom, from Linda. Total money brought in. Yes, good. Collected funds from work completed. Yeah, good. Yeah. Can you see Linda's question, Tom? Does it show up on your screen?
No, I can't. What is it?
She wants to know, would revenue include the 3% credit card service fee that's collected when client pays by credit card, or just what the staff is paid on?
The revenue, the 3% credit card service fee collected when client. So I guess in her case, if somebody's paying with a credit card, she's charging them an extra 3%.
That's what it sounds like. Is that right, Linda? Are you charging an extra 3% if somebody pays you by credit card? Let us know about that.
Yeah, I mean, that would be a form of revenue as well. Sure, that's money coming in. Money coming in would be revenue in the context of what we're doing here. Okay, so you got your 45% gross profit. You take the 100,000, subtract what you paid the people cleaning for you. So you got the money that your customers gave you, subtract what you had to pay the folks cleaning for you. You got 45,000. This operating expense.
Hold on a second. We got a no over here from Leslie, Tom. You're probably going to have to slow it down just a wee bit. We got a no over here from Leslie. Leslie, what's our no for?
Okay.
Give us a little bit more information there. Also, before we move past that, while Leslie's doing this, who can tell me what Cogs are? First person wins. First person wins.
Wins what?
What?
What do they win?
They win a star, Tom. I'm keeping track over here. All right, who's going to win the star? Not yet. They didn't put it up there yet.
Okay. Right. So
So Leslie, tell us what your no is.
While we're waiting for COGS, the operating expenses are, for the most part, all of what you would say your fixed expenses or semi-fixed expenses. It's your rent, it's your utilities, it's your advertising, marketing cost, it's your, if you have leases.
We need
Okay.
celebration. Yay. David got it first. Linda. Cogs, what you pay your staff. Close, Linda.
Okay.
Good job, David. Linda, close. And Tom, you see what Linda's answer is here. Do you want to speak to that at all?
For what you pay your staff is a proxy for cost of goods sold. There are a few other things that technically go into cost of goods sold, like cleaning products and things like that. But if you look at all your variable costs, let's think of it as a pie. Your direct labor, what you're paying the people that clean for you, is a huge part of that pie. And all those other things are a very small part. So when you're trying to make some judgment on a day-to-day, week-to-week basis, are you being efficient? Are you being productive? Are you getting the gross profit margins that you need to get? The easiest way to do that is just to look at your direct labor cost as a percentage of the revenue that you're generating. So technically, if you talk to your CPA, they'll say, well, there's other costs involved. But from an accounting standpoint, there's this term called materiality. In the whole scheme of things, when you're running your business day to day, making business decisions from a managerial accounting standpoint, we had Dan Platt on yesterday, and Blue Skies Accounting, they do bookkeeping for other companies. And he was talking about managerial accounting versus tax planning and the things that your CPA does. CPAs are necessary and they do great work, and they certainly keep you out of trouble with the IRS. But a lot of times you have to use estimates and percentages just to kind of get rough numbers to figure out if you're getting the outcomes that you want, especially on a day in, day out basis. You don't have all day long to calculate some of these things out to the level that you would need to get true cost of goods sold. So you hear us talk about payroll percent of revenue. That's in essence, we use that for COGS as a substitute for COGS, and a lot of times just because it's a much easier number to get, we can get that number anytime we want it.
So Linda, when we're talking about PPR, that would be like when Tom says that's a proxy for COGS. It's a really good number to use if you don't want to figure out all of the little tiniest pieces that you have to add on to payroll percent to revenue to get what your accountant would probably consider cost of goods sold. Hopefully that's a little bit clearer there, because COGS is a hard number, a hard number to define, because not everyone defines that number the same. What's included in COGS? Wouldn't you agree, Tom?
Absolutely. There's there's some art to, and different people do it different ways, and there's, within bounds of reasonability, there's a lot of different ways you can do it and still have a useful number, as long as you set a way of doing it and follow it consistently. As long as you have a method and a format, and we'll give you some examples of that here down the road. But on a monthly basis, you should be able to produce, or whoever does your bookkeeping should be able to produce a profit and loss statement. And we haven't gotten to that yet, but that's one of those things you get out of QuickBooks that kind of shows you some of these numbers that we're talking about here in more detail. On a monthly basis, they should be able to give you COGS, but I want to know, like on a weekly basis, after every payroll, we should know what our payroll to revenue is. And if it's not where we want it to be, figure out why it's not and make some changes, so next week you're getting the results that you want to get.
we're going to jump into Leslie's question more in depth because it is super helpful to understand that. All right.
So revenue is the money that your customers are giving you, the money that's coming in. Cost of goods sold, for all practical purposes, is the money that you're paying the people that are cleaning for you. The difference between the two is gross profit. And gross profit is really such a huge part of this because there's two things that happen with gross profit. Gross profit pays for all these operating expenses down here, your rent, your advertising, your leases, so on and so forth. And once it does that, if you're making profit, you've got money left over, and that gross profit starts coming to the bottom line as net profit. Does that make sense?
Another thing that you talk about a lot is variable costs. What do you mean when you say variable costs? Sometimes you talk about fixed, sometimes you talk about variable. How can people remember that term variable?
If you clean one more home, do you incur an additional cost? You know, if that cost goes up when you clean one more home, that's a variable cost. If that cost is the same if you clean one more home, then it's a fixed cost.
So example, if you clean one more home, you have to pay people to clean it. So that is going to go up. But if you clean one more home, you don't have to pay any more money in rent. So that's a fixed cost because that just stays the same. So that's how you remember it. Variable are the ones that change every time you clean a house, and the fixed are the ones that don't change regardless of whether or not you're cleaning a house. Okay. Everybody have that? If you have that, say yes. If you don't, say no.
So,
all right, go ahead, Tom.
So we want to think about variable costs in terms of percentages to revenue. In fixed costs, we think of them in terms of dollars. So when we start the month off, basically the game plan is to get as much gross profit as you can by keeping your cost of goods sold as low as you reasonably can as a percent of revenue, so you can pay off all those operating expenses. And as soon as you do that, every dollar it's coming in, that gross profit percentage is net profit, which is the name of the game.
All right, so we have Linda is getting this concept of fixed and variable. She's the only one that's commenting that she's getting it. I hope that doesn't mean that we have other people that are not getting it. We're going to kind of move on, but tell me if you're not getting it for sure, so that we can, we'll just hit it from a different direction. So one thing that you'll notice is every time we talk about this, we talk about it just a little bit different and use the words in a little bit different order. And a lot of times that's all it takes to start making those numbers sound really, really normal and regular. All right. Oh, I love your new little graphic you got here, Tom. That's new. I haven't seen it.
Yep. We're attacking this several different angles.
All right.
Okay. So we talked about revenue, cost of goods sold, operating expenses, net profit. We know what those are, right?
Yep.
Revenue is the money coming into us. Remember, we said cost of goods sold, a proxy for that is your payroll to revenue number, and that's a percentage. For every dollar you bring in, for every home you clean, you're going to be paying something to cost of goods sold. The example that we looked at earlier said our cost of goods sold was 55%. Okay?
Yeah.
So for every dollar that comes in, 55 cents, I got 2 quarters and a nickel here, is going to go to cost of goods sold, right?
Yep.
So that means I've got another 45 cents, a quarter and 2 dimes that's going to be flowing down. So where is that quarter and those 2 dimes out of this dollar? Where's that going to go? This is my gross profit, remember. It's first going to go to my operating expense.
Okay, so the way this graph is written, it kind of looks like 45 cents is going to go to operating expenses, but it's not, right? It doesn't have to. And ideally, we wouldn't want it all to go to operating expenses. 45 cents is really our gross profit.
It is.
Right? And then we're going to spend some of that on operating expenses. Is that right?
Well, say it's the beginning of the month.
Okay.
At the beginning of the month, but before you get to the end of the month, you need $25,000 to cover those operating expenses, which are fixed, right?
Yep.
So if you're going to be looking at this from a monthly perspective, you're not going to make $1 profit until you've got enough gross profit to pay that $25,000 operating expense.
So is the 45 cents equal to $25,000? How does the 45 cents play into the 25,000?
What happens is for every dollar that comes in, 55 is going to go to cost of goods sold, and that's going to be happening that way. If you bring in $1 million, still 55 cents of every dollar is going to be going to cost of goods sold. This 45 cents gross profit has to go to operating expenses until you've got enough 45 cents going in here to equal $25,000. And that's what we've got going on right here. You've got each one of these stacks of $50 bills is $5,000, and there's 5 stacks of them. So you've got $25,000 here.
Okay. So how many expenses do we need to get to $25,000?
That's a good question. And we're going to be able to answer that here in a little bit.
All right.
So this is called break even. At this point, you're to the point where you've paid all your people for the month, or you're covering all your payroll, you've covered all your expenses. You're not sitting there at the end of the month with bills that you don't know how to pay. You've broken even, but you don't have any profit either, right?
Right.
But once you hit that break even point, no more money goes this way for the month. The rest of it flows down and goes to net profit. So that's how we make money.
Okay, let me know in the comments, is this graphic helping to illustrate or not? Give me a yes or a no. We're working on trying to create some graphics that are more useful, you guys. If this one's really helpful, please give me a thumbs up. Let me know, yes. Otherwise, tell me a no, whether we should move forward with this graphic. All right, just trying to get some more clarity. David, give me a heads up on this. Yes or no? Leslie, what do you think? Linda, who else is on here? Dan, Celicia, we got a lot of people on here. You guys let me know. Good graphic, not helpful. Dan's liking it. All right, good. Thanks, Dan. All right. The thing about this whole idea, this whole concept is we got to find different ways to present the information because it's a hard concept to grasp. Okay, Rosemary says, yes, it's clear. Excellent.
In the example that we had, where we had the little really small P&L that showed the $100,000 in revenue and the $55,000 cost of goods sold and $45,000 gross profit, we said $25,000 operating expense. It showed a net profit of $20,000. So at the end of the month, we would have had enough of these 45 cents flowing down into this bucket to have $20,000 left over.
Yay, we like that.
So that's how we make money.
Yeah.
But you gotta cover this operating expense as quickly as you can, and then every house that you clean looks like profit.
Okay, thank you, Linda. Thank you, Denise. Tom, looks like this is really helpful. We're getting a lot of yeses over here. So thank you, you guys. Good.
That is awesome. Thank you.
Yeah, sounds like people are really getting this concept.
So let's look at this for a minute. The example that we're working from assumes that our cost of goods sold is 55%. That's what we've been talking about all the way up to this point, which means for every dollar that comes in revenue, 55 covers these Cogs, our variable cost, and 45 goes in this bucket, just accumulating until we can get $25,000, 45 cents at a time to make that go away, right?
Yep. It's not spending it all on operating expenses. It's just available for operating expenses.
So the question that Leslie asked last week was, why do we have to break the variable cost out from the fixed cost? Why does it really matter?
Ones are variables. The Cogs.
Cogs. Why do we separate Cogs out from the other operating expenses? Cogs I mean, yeah, the COGS, variable, operating expenses, fixed. Why do we care about separating them?
Yeah. Why does it matter? I love this question. We get this question all the time. It's a great question because it doesn't seem like it should matter at all. I still got to pay it. It's all got to get paid. Why do I have to separate it?
When you separate it, and you can think about the dollar coming in and how many cents are going to cover the COGS, the variable, and how many are left over to go in the bucket to cover the fixed, the operating expenses, and you know what that dollar amount is, you have a much better idea of, am I making money today? Am I making money by the end of the month? What do I need to do to make the money that I need to make? Mm-hmm. And there's knobs that you can turn. There's decisions you can make. There's things that you can do at this point. If I want to make more money, if I want to get more net profit rather from the $100,000 in revenue that I have, what are some things that we might be able to do? What would you do, Liz? What would you want to do to make more money? Huh?
So I was asking the audience here if they have any ideas. What are some of the first things that you might look at? What are some of the first things that you might do to be making more profit? So there are a lot of things that you can do, and I'll just throw two out there real quick, and you tell me which one you think would be maybe making more sense. Some are easier than others. So sometimes we might choose the easier thing because it's something that we feel like we can do really quickly, or it's just easy. So what if, would it be, I don't even know how to ask this. Here are my two things. Sell more and reduce expenses. All right. There's something that we can absolutely do to increase our net profit. What if we just sold more? What do you guys think? If we just sold more, but we didn't necessarily reduce expenses, because why do we have to? I mean, we sold more stuff. Do we have to? Will that get us more net profit? So somebody give me an answer over there for that. And then another example that I have is I've got two things here. Which thing seems like it would get better results? What if we went through our P&L and we looked at all of our fixed expenses and we just started eliminating fixed expenses or reducing? So we find a cheaper gas station to fill up our cars where it's 4 cents less per gallon, which can add up to a lot of money at the end of a month, right? Or we reduce our phone bill to a different phone system, something like that. Does that make more sense? All right, let's see what Rosemary says here. It will get you more profit if your numbers are in alignment, no more than 55% COGS. All right, Tom, what do you think here?
No, we've seen company with COGS higher than 55%, haven't we?
Yeah, we've been a company with higher than 55% COGS.
We don't need to talk about that.
We don't want to revisit that. It's painful memories.
not for long term, but it has been known to happen.
But for a day, we did have a day.
We had a week.
Yeah,
but nonetheless,
that one day. Oof.
But Rosemary's point is well taken. I'm going to go to another slide here because we got 55% COGS. So for every dollar coming in, if I got 55 cents going here, I've only got 45 cents in gross profit. That's one scenario. How about a scenario where we can get our COGS down to 45%? So we've got 45 cents of every dollar going to COGS and another 55 cents coming down here as gross profit. Right? Which one would we rather have? Which scenario?
We definitely want lower cost of goods sold. It would be much better to have 45% in COGS than 55. Much better. And like by a large margin too.
You know why? Because I've got this bucket here that I've got to come up with $25,000 in that bucket before the end of the month, before I even get $1 in profit. Am I going to fill that bucket up faster if I've got 55 cents out of every dollar going into it, or 45 cents out of every dollar going into it? The more change I have coming down this way, the faster I'm going to fill that bucket, right?
Mm-hmm.
Does this help? I don't know. This made sense to me.
So it makes sense, but looking at Rosemary's statement, Tom, how does that play out with what we're talking about? Because what Rosemary is saying is, so are we talking about more actual money in the bank when we're talking about net profit, or are we talking about percentage? Because of what Rosemary is saying is, you'll get more profit if your numbers remain in alignment. You keep that 55% in COGS. Your fixed expenses will stay the same, and you just bring in more money. You'll have more net profit. How will your percentages look?
And the percentages are relevant all the way up and down the P&L, if you will. The percentages are crucial when you talk about COGS. COGS mean nothing from a dollar standpoint. COGS is all about the percent to revenue. When you start talking about profit at the end of the day is cold hard cash. You can look at it in terms of percent to revenue, and we all do, and we should. But the fact of the matter is, some of the most profitable corporations in the world have a very small net profit to revenue number. You know, Walmart, for instance. I mean, it's a couple of cents. I haven't looked at their numbers in a long time, but when you're bringing in billions and billions of dollars in revenue, you know, a couple percent is a whole lot of money. Yeah. In the house cleaning world, when your cost of goods sold, when your payroll to revenue starts getting, 55, 60, 65%, it can be hard. But there are business models out there, if you really want to get into it, that have next to nothing from an operating expense. There's people out there who have solo cleaners, they might be independent contractors, right? Or they might be employees. It doesn't really matter, but they have no office, they have no vehicles. Basically they have a website and a mobile phone, and they're making a business work. When you're doing that, and if you've got relatively no operating expense, your your cost of goods sold percentage can be higher, and you can still make money. If you're running a more traditional business, I say traditional, from my perspective, where you've got a brick and mortar office, and especially if you've got cars and things like that, 55% is awful high. It's going to be really hard to make money at 55% if you've got a lot of operating expense you have to cover.
All right, Tom, so while you copy and paste Linda's question onto the window, I'm going to give a smaller answer to Leslie's question, kind of a simpler answer. The reason why you separate them out, Leslie, is because it's easier to impact your numbers in a big way by addressing COGS, because the COGS is a much larger percentage as a whole. So when you're talking about operating expenses, if you just hit one operating expense here or there, just the phone bill, just the gas, just this, you're making much smaller changes percentage-wise than if you can make a change to your COGS, because that's such a large piece of that pie.
It's the difference between having 45 cents coming down. Really, this money up here, I don't even think of that as mine. Basically, that's going to the people that are cleaning the homes for me. The money that's coming down this way, in this example, 45 cents, I need that to pay the rent, to pay for, leased equipment, to pay for marketing, and get all that out of the way, so I'm making money by the end of the month. Mm-hmm. The more of this dollar that flows down this way, the quicker I'm making money, the more money I'm making. If all my money out of this dollar is flowing to COGS, I'm never making money. And we've seen examples of people who have COGS that are 70, 80%. So if you've got 80 cents of every dollar going here and you're only getting 20 going down in this way, you're never going to make any money. I'm saying never. It's
So
almost impossible.
it's so hard because then you just can't have any expenses.
But you don't know why. But you don't know why, because all you know is money comes in, money goes out, and there's nothing left over. But when you can look at it,
a lot of money. You can be bringing in a lot of money, and it can be coming in really regularly, and it feels like you have a lot of money. Look at all this money going into the bank. What the heck? So that would be why. All right, Linda, before I let Tom answer this question, I want you to think in terms of what we said about COGS and operating expenses, that the COGS are variable expenses, and you decide what goes into your COGS based on whether or not the number that you pay out is going to be more for every house that you clean. So you clean another house, are those numbers that you asked about, are those numbers also going to go up? Are you going to have to pay out more? So the employer's share of the payroll taxes. If you clean another house, will you have to pay more in the employer's share of the payroll taxes? And let's go to the next one. If you clean another house, will there be more mileage to reimburse? And if you clean another house, will there be more workers' compensation fees? So for each one of those things, what's your answer? Yes or no? And that's how you get your answer there for a true COGS. So the reason why it's tricky is because you'll talk to different people and they'll say, you'll hear this term that we haven't even talked about yet, loaded and unloaded, right? So unloaded COGS is really just your payroll. So that would be what we call the PPR in your workbook, Linda, your payroll percent of revenue. That would be that number. That's an unloaded cost of goods sold. It means that there's other things you're going to have to pay that are variable, that are going to change every house you clean. But we are just going to talk about the payroll portion because that is such a large portion of COGS. Right, Tom?
correct. Now, you can, and a lot of us do, once we get a little further into this, it's a good idea for you to figure out what your payroll taxes and all these other expenses are as a percent of the payroll going out. Like, for instance, part of this tax is what the employer pays for Social Security and Medicare, Medicaid, all of that. And I think that's like 7.6%. So you're guaranteed to take, if you're paying $100 in payroll, you need to add another $6 and some odd cents just to cover that part. And then if you figure out you pay your workers' comp as a percent of payroll, so you know what that percentage is, you know what percent you're paying to unemployment insurance and so on and so forth. So you can add all of those up, and you typically come up with a number depending upon where you are and depending what your workers' comp is. It can be 12, 13, 15. It could be over 20%, just depending. And you can add that on. So if you got $100 in payroll and the load factor comes up to be, when you add it all up, 15%, you would treat that loaded payroll cost as $115. And that's a more accurate number of, when you use that as your COGS, that gives you a more accurate number of how much change is coming back down. Where'd my cursor go? That's a good accurate. The more, by throwing that load in there for payroll, that gives you a more accurate number as to how much change is coming down here to cover your operating expenses and net profit.
And one more thing I want to say about the variable and fixed thing. Keep in mind that when we're talking about the words variable and fixed, that it's always in relation to cleaning another house. Because sometimes where I hear people get stuck is, it seems like the workers' comp fees is not is a fixed expense because it's always the same amount to payroll, right? It's always the same percentage. So people can think that it's a fixed amount, but it's not, because you have to remember that variable and fixed costs have to do with cleaning another home, the comparison to cleaning another home. So does it change if you clean another home? Okay, so keep that little piece in mind because that's really, really important.
Even if you've got a policy where you're paying the same amount every month, at the end of the year, they're going to do an audit where you either owe them more money or they owe you money back. So that's where, they get that resolved.
Why it's variable, y'all. And so it really is important to know that number, especially like for you, Leslie, because you are in California and that number is so high, right? It makes such a big difference that you have much less gross profit than, places where they have much lower Cogs, lower workers' comp fees, lower minimum wage that they can actually pay, right? Some places can really pay, believe it or not, you guys, $8 is a decent wage in some places. It's hard to imagine when we're paying 15, but for some people,
those places are becoming fewer and further between now. But they're definitely
2021.
Definitely can pay more in wages in some markets than others, though. And you guys are on the higher end of the scale.
All right. So did you answer your own question? Tell me, do these things get included as part of COGS or operating expense? Let us know. What do you think? Your own little quiz here. All right, Tom. Oh my gosh, I can never get over how fast this hour goes.
We're out of time almost, but
we still have a few minutes. Yeah.
What you do? We'll cover this. We'll cover this down the road, where we'll show you how to figure out these percentages, and you can just take whatever your gross payroll is and multiply it times 1 point some number, 1.15, 1.17, whatever it is for your company. And you're right, Linda.
Yay.
Aren't you glad I dug that up?
I am glad you dug that up. Good job. So good job, Linda. And so just a quick reminder, because we're talking about the lingo again, the lexicon. Remember that Tom said that payroll percent to revenue can be a proxy for COGS. So remember what he meant was, because the payroll percent to revenue is such a large portion, sometimes people will use it in place of the COGS number, but they just have to keep that number lower because there is a load on top of that. And that's what we mean by the load, which is all the stuff that you're talking about right here. Right?
Once you know what that percentage is, it's just really easy just to go ahead and add it on, and that gives you a more accurate picture of how much change you have coming down here.
What your actual COGS are.
Yeah. Well, it's still not even actual because you got your cleaning products and a few other things in there, but that's such a small part that it's not material. So if you ever think that I'm not being profitable, I need to go out and find a better deal on window cleaner, you're not looking in the right place. That's not where the money is.
Yeah.
The money here is in the COGS, because right here you've got 55%, which is a little bit on the high side for a lot of business models, but they got a really low operating expense and they're still throwing off $20,000 in net profit, 20% to revenue. But if you're able to get COGS down to 45%, that $20,000 becomes $30,000. So you make an extra $10,000 by cleaning the same number of homes just by getting COGS down.
So how do you get COGS down, Tom? We probably don't have time to talk a lot about this today. Is that coming soon? Because boy, that really looks like the way to make some money right there.
It is. And there's we'll probably spend a good chunk of time next week talking about COGS, but depends upon how you pay your cleaning technicians. It depends upon how you do your training, how you do your scheduling, it's just so many things that go into that can basically get you to the point where you can clean more homes with less labor, and that's where the magic happens.
So David wants to know if Cogs is about wagon wheels.
Oh, David.
Yes, it is, David.
Thank
All right. So, yes, one of the things that we are going to have is a list of things that you can do to impact your COGS, to reduce that number from whatever it is. If it's sitting at 70%, really, if you can get it down to even 69%, that's better. 68, even better. 65, yes, going in the right direction. So you want to just start trending in the right direction. So we're going to have a whole list of things that you'll be able to do.
But we want to be able to get our COGS down as low as we reasonably can to get as much change out of every dollar flowing down here so we can cover our fixed expenses, our operating expense, and to eventually get as much money in this net profit bucket as we can.
And so all three of these places are places that we can impact. So Rosemary gave an example of how we can make more money by increasing revenue, more sell more stuff, advertise, etc. Right? So
and
go ahead.
It made central. We talk about red numbers and green numbers. You want to make the green numbers go up and the red numbers go down. Revenue is a green number. So if you want to make more money, one way you can do it is make the green numbers go up, make the revenue go up. The red numbers, you want to make COGS go down. You want to make operating expense go down. If you can make those go down, you're making more money too. You're making more profit. If you can make the green numbers go up and the red numbers go down at the same time, then you're making even more money.
Yeah. So all of these areas have levers that you can tweak, right? Ways to be able to get more revenue, ways to lower COGS, and ways to lower your operating expenses, ways to get that red number down, ways to get those green numbers up. And your job that we're going to be talking about next week is to figure out which one of those numbers is causing you the most amount of grief. Is your green number too low and you really need to be getting that number up? Is that going to be your biggest lever? Or is your COGS too high and that's going to be your biggest lever to push down? Or is your operating expenses too high and that's going to be the most important lever to push down? So that you can, there's my fancy clock, Tom, sorry. This is Christmas clock.
Leslie's question from last week, that if we don't separate the variable costs, the COGS, from all of our expenses, so we've got our variable COGS and our fixed operating expenses, we don't even know where to look. All we know is we're not making money, or maybe we are making money. In either case, we can't explain why, it's just happening. But once you break your COGS out separately and you know that percent of revenue and know how much gross profit you have, then you can start turning the knobs and making decisions and doing things in your business, and then measuring to make sure that you're getting the results that you're looking for and anticipate.
Yeah.
Does that you think that we've answered the question as to why it's important to break COGS out separately from all your other operating expenses?
Yeah, let us know, you guys. Yes, let us know. Type in yes if you feel like that makes really good sense to you, why we should separate them out. Gives you more opportunity. It gives you more clarity, gives you more vision for your company. Type in a yes. If it's not, don't type in anything, and we'll hit this again a little bit more. Yes, thank you, Rosemary.
Yeah, and if it does, I mean, you can drop comments in here even after we're done, and we'll go back and we'll check. If there's any specific questions, or if we're not getting it, we'll try it again.
Lots of yeses, Tom. I'm glad. Awesome. Don't be shy. If there is a no, anybody has a no here where not quite yet. Just it doesn't really make sense. It still seems like they both could go together because I just need to impact them. Don't feel shy. Throw me a no out there. That's great information too. We want to make sure that every single person that gets on these Facebook Lives with us on Thursday is getting exactly what they need to get a really clear understanding, because we know that when you get off the Facebook Live and next Tuesday comes around, you're going to be thinking again. Some of you are going to be thinking again, now, what was the fixed expense again? Which was the variable expense again? What's a payroll percent to revenue? What is that again? What are Cogs again? We know. So we're going to keep hammering it and hammering it and hammering it until everybody's like, oh my gosh, I got it. I got it. Easy.
But by the time we're done, you're going to be able to see this in your business.
Yeah.
So when that Mrs. Jones says, well, I really don't want my home cleaned today because of blah, 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 and whoever's on the phone lets them off the hook easy, you're saying, well, wait a minute, Mrs. Jones pays, $100. That's another $55 in net profit that we're letting out the door. No, Mrs. Jones, you really want us to clean your home today because, you're going to fall out of our schedule and different team next week. It's like, it's really important. We can do this for you. And everybody's going to try a lot harder to keep that last job on the board when they see it in terms of, this 55 cents out of every dollar is just going away and you're never getting it back.
Great. I'm glad.
Thanks, guys.
I have to say one thing real quick to Linda. Linda, I know it seems like we need more than 1 hour a week, but I want to let you know that a true learning piece of information is that you learn better with a break in learning. So believe it or not, learning it every week, you're going to learn it better than if we were to hit you for 3 hours all at one time.
Yeah.
All right.
We're not going anywhere. And
Nope.
we're just starting. Okay, guys. Thanks so much. Have a good rest of your week, a good weekend. We'll be back Monday, Sharon Tinberg. So I don't know if you missed that this week, you're going to want to come back and watch.
Yeah, listen to Liz. Give Sharon grief.
Take care. Bye-bye.